Here to one of my favorite places in Short Hills, the Squirrel and the Bee. Thanks so much to Michelle Reddick for letting us host it here tonight. I am really excited because I think most people I know are so happy to pay their taxes as long as it's not more than their fair share. And so what we want to talk about tonight is how you can assess whether or not your taxes are the right amount, close to the right amount for you, and if you're not sure what you should do. And if you're pretty sure that you are paying too much, what's the process that you should embark on to try to get them back in line? Evan Drachman is a local real estate attorney that I've been working with for well over a decade. I mean, I don't know, maybe probably 15 years or so. Evan does, I believe, as many real estate transactions as anyone locally. He knows the market, he knows the pitfalls, he knows how to hold transactions together, he knows how to help people get out of a transaction if that becomes necessary. So I just find there's really no real estate attorney in the area that is more knowledgeable or a better partner to work with than Evan Drachman. So
Thank you.
Really, thank you so much for coming.
Thanks for having me. Thank you. Thanks for having me. My name's Evan. Today I'm here talking about property tax appeals. I do keep my notes in front of me because I lose my train of thought. I'm happy to answer any questions. So if anyone has any questions, just jump right in. We have a small enough group so we can really talk this through. I'm going to start with some basics, really, about to kind of catch everyone up about why tax appeals are relevant and how to determine if the tax appeal is good for you. Taxes are determined really with two factors. It's a formula. It's your tax assessment and it's the tax rate. Those two numbers together, you get what you pay in taxes. Tax rate, you're not really going to have much luck changing. Tax rate applies to every property in any given town equally. The only way to change it is to change the municipal government. Those are the ones that dictate your tax rate. They come up with your municipal budget, and then they come up with the tax rate. The assessment, that part of the formula, that's the part we're really focusing on today because that's the part when you're filing a tax appeal, which the goal is to lower your taxes, that's the part you're actually appealing, is the assessment. You're not appealing taxes. The reason why I make that distinction is because a lot of people say, oh, you know what, I'm paying more taxes than my neighbor. It doesn't really matter for this purpose. What matters is whether or not the assessed value on your property is equal or approximately equal to the market value of your property. What could you sell it for? That's why, among a lot of other reasons, it's always good to know what your market value is. You know, it's important to keep track of comparables that you may have you may have in your neighborhood, in your town, to know about what your property is worth. Without knowing that key aspect or having at least a loose idea of that aspect, you're just not going to be able to determine if a tax appeal is going to be relevant for you. When you're also doing a tax appeal, one of the reasons why it's important to know this stuff is because you could file a tax appeal and you could lose. And if you lose, you could get hit with an increase in taxes. So simply saying, oh, you know what, I pay too much in taxes, and running into the county tax board, filing a tax appeal, and going to a hearing without knowing what you're doing could have serious ramifications, more than just losing.
Wait, because your house is worth more than you thought it was?
Correct. If you just simply think, I'm overtaxed, I pay too much in taxes, that just means you're just like everyone else. We all think we pay too much in taxes. So if you're going to run into court and file your tax appeal, but it turns out you're not overtaxed, you're actually paying out less than you should be, the township could take the argument and say, oh, yep, these people are undertaxed. We want to argue for a higher tax, and you could lose and end up with higher taxes.
You know what, I just want to chime in on that point is that we have to remember it's very subjective. So your question is a good one. You know, what do you mean my home is worth more than that? Well, your home is worth what somebody's willing to pay for it, as we all know. But when you go in and fight these appeals, on any given day, you could get a different answer. It is very subjective. You can bring comps to help support what you think your house is worth, but there's a lot of subjectivity in that.
Okay, and I assume you're going to get into this, but like you can be selective when you choose comps, right?
Yes.
And
so
presumably that won't fly in court. Right?
No, so it will fly in court, and that's part of what we, as lawyers, do. We present the best possible case on behalf of a client. Now there is an adversary, the town. they are going to bring their own set of comps. And sometimes we end up going back and forth as to why one comp is more valid than another, why one is not. Sometimes when necessary, we'll bring in an expert witness, an appraiser, who can come in and say, you know, this property, while it has a larger property, half of the property is unusable because it's on a slope, and that affects value. So, yes, you absolutely should be selective on the comps, and that's part of presenting any good case in any type of negotiation. You want to present your best case, and yeah, that's their obligation to tell you why you're wrong. You should only present the best stuff for you.
And you know, I think it's sort of evil to look at them, or it's sort of easy to look at them as the evil dark side. But remember, they're actually protecting the rest of us because they want everybody to pay their fair share, because the budget is the budget. If there's a shortfall, then they just raise the ratio so that everybody pays a slightly higher ratio. So when they're arguing your comps against you, to a degree, they're actually supporting the rest of the town.
At the end of the day, any municipality has to raise enough money through taxes to keep that municipality running. If you and everyone you know files a tax appeals and you win, well, they're bringing in less money. That simply means that you might, while you may have gotten a lower assessment, eventually that tax rate has to go up. So there is a give and take. So, you know, if you're just filing a tax appeal for the sake of it, they are going to fight back because the town doesn't want your assessment lowered when it's reasonable. When it's high, we can usually resolve it. But when it's reasonable, they don't like to argue back and forth. So I'm going to talk a bit about how these assessments work. When you look at your tax assessment, it's important to know that's not necessarily what the township thinks your property is worth. The tax assessment, the value that the town has on the tax roll, is kind of a placeholder. It was accurate at one point. Every township periodically goes through revaluations. We were just talking about Westfield is going through one now. Milburn just went through one within the last year or so. When these properties when the revaluation happens, the intention is every property in town is going to be valued at market rate. So during the year of a revaluation, your assessed value is intended to be exactly your market rate. However, revaluations are expensive and they take a long time. So town governments don't do them every year. Otherwise, everyone's taxes would be that much higher. So instead of, so it's done, those revaluations are supposed to be done at least every 10 years, or when the assessed values are more than 15% away from market values. It doesn't always happen. So a lot of towns haven't been reevaluated in more than 10 years. A lot of towns are way more than 15% away. What happens in those situations? Not much. The state will sometimes get involved and force towns to do a revaluation. I live in Jersey City, and that's what happened last year. The state got involved and forced Jersey City into a revaluation.
Is that because the state has an interest in offering less support to Jersey City?
No, it's because the state has an interest in getting the tax variable, the assessment, up to market value. The closer these are to market value, the more, in theory, the fairer the taxes are across the board. So in a lot of towns, as an example, in Jersey City, when the municipality was reevaluated in 1985, which was the second most recent one, different neighborhoods in Jersey City had different values. Since then, there's been a lot of overturn. So different neighborhoods now have different values relative to the other places. So certain places which have artificially lower taxes because of those revaluations, because of those assessments, weren't paying their fair share. Yeah.
Yeah, we just received
The property card.
Yes, so I think it's exactly the same as last year, whatever.
Correct.
So this means they didn't do any
Correct.
revaluation.
There was no revaluation.
They just write down.
No. So the reason they do that is they're by law required to tell you of your assessment every year. It doesn't mean it changes every year. Every year they have to tell you. So every year you're going to get the card, and it's probably going to be the same, at least for a couple years. Eventually it'll change, but when it changes, anyone who lives in a town that's had a revaluation, you know about it. It's big news, neighbors are
But
talking,
it
it's
only
big.
changes if there's a town-wide reevaluation.
That's the most common way to change. Assessments can also change other ways. Assessments can change if you've done construction on your property. Usually if you add any type of living space, an addition, that's going to affect your assessment. Internal renovations doesn't necessarily affect the assessment. It's somewhat of a judgment call by the tax assessor. If you're doing a whole house renovation, they're going to hit you. If you're renovating a hallway bathroom, they're probably not going to get you so bad. So any construction that you take permits out for can lead to a tax increase, but certainly the bigger the construction, the more likely.
People are always worried that when they buy the house, because now there's a reported new value, they're worried that it's going to be reassessed.
No. Simple. That's an easy one. No. No municipality that I'm aware of reassesses simply based on a sale. It just doesn't happen. If that were to happen, the township really would have to file its own tax appeal against you as homeowner. They don't do that because town government isn't really looking to start, in essence, suing their constituents. So that doesn't really happen unless there's something egregious, and at that point, it's expected.
So it's
Wait.
still based on the sale price, just like you said. I just want to confirm.
I'm sorry, repeat that?
So the fair value of the, still based on the sale.
Well, fair market value is based on the sale price, but the fair market value is not the assessed value. The assessed value is based on the fair market value whenever it was assessed. Sometimes that might be 3 years ago, it might be 15 years ago. That assessment won't change without some action. That action might be construction, it might be a tax appeal, but otherwise that assessment will not change. It's important to know that if you're having a revaluation, you should consider letting them in. They're gonna, when they do a revaluation, they come to every property and they are allowed to come in. You can say no, but if you say no, you lose the right to file an appeal. Now sometimes saying no is a benefit because you end up, like we discussed, with lower taxes. But if you end up with higher taxes, you cannot then appeal because you in essence prevented them from giving you a fair value. So it is important to kind of make that determination and then go. It doesn't prevent you from appealing ever, but just for that year.
Wait, how would they raise your rate if they couldn't come in and reassess it?
They go by neighborhood. They go by their best guess of what your house is worth. Because don't forget, towns have on record most of the details of your property, from when it was built or when there was construction. So they can give a reasonable estimate, and their estimates are usually, when they don't have access, they usually assume the house is maintained, in good condition, with updates. They don't assume it's in bad condition. So if you have a newly renovated house, it may be worth it not letting them in. If you haven't touched your house in 20 years, you should probably let them in. So you kind of have to go through that balance.
Oh, so is that during the PE, sometimes they come to inspect your house?
When you file a tax appeal, they have the right to inspect your house.
But usually they don't, right?
They usually do not, in my experience. Yeah, they usually do not. If you have valid comps, and you have, especially if you have an appraisal, or if you are in the situation where you purchased within the last year and have a market value based on your closing, they don't usually come in. Look, the tax assessors are like every other worker. They're not looking to do extra work.
Yeah. Two questions. One is, I think it's really useful information. So if you just bought a house, and then the house, there's a price there, and then the price actually is less than the assessment price, just the car you received. That's one question. How they are going to evaluate the
So I'm going to get to that in the next part. So, all right, so that's really about assessments and how we get assessments and how those assessments are used. Like I said, however, assessments are not, in most towns, they're not the fair market value. They're not the current fair market value. In order to determine what the town thinks your value is, there's a number called an equalization ratio. And this part's a little complicated, it's a lot of math, but this equalization ratio is the ratio of market value to assessed value. So the towns know, hey, that assessment from 5 years ago is no longer accurate, but it's too expensive to reevaluate everybody. So we just simply apply a ratio, which is applied uniformly across the town, which is intended to convert that assessed value into a market value. The ratio is determined by the state. It's not determined by the town, so it's determined on the state level, and it's determined by looking at all the closings that happened in that year that are quote-unquote good closings, meaning they weren't distressed sales and they were arm's length, usually with realtors involved. And they look at what those ratios of prices are to the assessed values of those property, and they extrapolate a ratio that is then applied to the municipality.
So what's the ratio right now?
So again, it's different by town. In Milburn, it's 92.31. But they come up with that ratio, and that's the ratio that really is the key to a tax appeal. Because that is the number that you can look at what your assessment is and use that ratio to determine how far out of value your property is.
And sorry, does that ratio changes every year?
That ratio changes every year, and it's released by the state usually in October.
So for this year, you said for Milburn is 92.31.
Correct.
Do you know what Summit is?
No, I don't have it handy, but I can look it up in just a moment. I printed out, it goes by county, so I printed out Essex County.
And Summit
Summit's in
hasn't
Union.
had a reeval for like
Right, actually, you know what?
20
I
something
did
years,
just
right?
pull it up a few minutes ago, so I can actually tell you right now. I think I have it here. Yeah, so Summit right now is at 42.77. So that ratio, for anyone else who wants to look it up themselves or later, it's called the Chapter 123 ratio. And if you type in Chapter 123 to Google, it is the first hit. I know because I do it all the time. So, and it's relatively easy to remember. Chapter 123. That's the ratio, and then it prints out when you click on it. You literally get a chart that looks just like this, no matter the county. This happens to be Essex County. So you get a chart, and it has average ratio, lower limit, upper limit. I'm going to get to those in a moment, but the average ratio is how you use to calculate what your property is what the town thinks your property is worth. And I have two examples that I'm going to kind of run through the whole tax appeal process. But just to give an example, this one is in Livingston. It has a assessed value of $717,800. Livingston's average ratio is 84.96. So that means that the town thinks that we do this assessed value divided by the average ratio. The municipal value, that's the value that the town thinks this property is worth, is actually $844,800.
So actually, the assessed value is lower than
Yes.
the fair market value.
Often. It doesn't have to be.
So
It all depends on when the revaluation occurred and how market prices have changed.
So if the house sold at 1 million, I'm just giving example, and then 11, then what's the assessment value? So it should be a X.
Well, it'd be in reverse. So you would take the
Assessed.
market value and multiply it by the average ratio.
Okay, so that's how you do the
Right.
math.
Can I give a little background on that too? So on the sheet that you have on your page, every year we take our version of kind of what the state does. We say, okay, let's look at everything in Milburn Short Hills that sold last year. We throw out ones where they're very skewed for particular reasons, like an $800,000 lot is still assessed at $800,000, but a $2.5 million house is on there. We throw those out, and then we take the average ratio that things sold for by their tax assessed rate. So, for example, on this sheet, you can see that in 2012 things were selling at 108%, in 2013 112, etc. Last year things were pretty close because we were just reevaluated in 2017. So last year things were selling at about 105%. Which is slightly different than the county numbers. It's
Right.
the other way around at 92, but
exactly.
we're saying the same
it's
thing.
Right, it's the
So it's
reverse
the
calculation.
sale price is higher actually. than
Right,
your-
so if your house was assessed at $1 million last year, it would probably sell at 106% of that on average.
That's pretty.
So that's kind of how that ratio works and what the point of the ratio is. I'm going to kind of walk through a tax appeal now and kind of the intricacies of that, because basics are really using that assessment and the ratio. First of all, tax appeals have to be filed between January 1 and April 1 in any given year. And the question in a tax appeal you know, it's one thing to say, okay, we're appealing the assessment. But the question that you really have to answer is, what was the property worth October 1 of the prior year? That's the vital date that towns assess properties as of. So October 1 of the prior year, and you have to file between January 1 and April 1. Tax appeals are usually filed at the county level. For residential properties, if the assessment is less than $1 million, it has to be filed at the county level. Above $1 million, you have the option to go to the state or the county.
Which one is better? County?
That's a strategic question. I personally, I almost always file in the county. And the reason I file in the county is really twofold. Number one, it's quicker. But number two, it's a much more informal setting. And in my view, it encourages settlement much more than at the tax court. The tax court is a very formal court. It's way more than special civil, like small claims. It's a very intense court. So I think the county level, it's much better for quickly resolving these matters. Some people like to file at the state level, you know, when the properties are very unique and, you know, you really are looking at special factors for a property. So that's why all commercial properties go there. But for the vast majority of residential properties, it's not, you know, it's no more complicated than an appraisal and determining a value. You know, unless you have some residential property that was built by a famous architect, you know, that's a national registered landmark, you're going to end up better off usually in the county level. So again, when you're filing a tax appeal, you're not appealing your taxes. You're appealing only the assessment. And the reason why that's important is also going back to the question of comps and what's valid. The valid evidence that you're going to use are comparable properties that have closed usually between January 1 and October 1 of the year. Those are the comps you're going to want to use. If you want to file a tax appeal on your property, valid evidence is not going to be, well, my neighbor pays less in taxes. It doesn't work. It has to be, oh, my neighbor's house, which is the same as mine, sold for way less in the time frame, right? Within the time frame. So it's looking at taxes makes no difference. Even looking at assessments makes no difference. Showing, saying, oh, you know what, this house is very similar to mine, and therefore this assessment is lower, doesn't matter. It has to be a sold property.
That, for me, is probably one of the questions I get most often this time of year. I'll have friends or clients call me up and say, Shannon, I know my neighbor's house, which is exactly the same as mine. It's a 4-bedroom colonial, the same size lot. I looked up their tax assessment and it's much lower than ours. So, you know, oftentimes I'll say, look, call Evan and discuss it with him, but I know what he's going to say. If their property didn't sell last year, it doesn't matter.
Right.
It doesn't matter.
It doesn't matter.
Your neighbor's lucky.
Right,
Great.
exactly,
You know,
and
they
that's
can
what it
buy
comes
you
down
a
to.
steak dinner, but that's it.
That's what it comes down to, is they're undertaxed. You might be taxed entirely fairly, but feel that it's unfair because your neighbor's undertaxed. And, you know, as someone who takes those phone calls, it's a bad answer to give that.
So you're suggesting you don't want to compare with your neighbor, but sometimes you want to see how much they sold their house
Correct.
last year.
Yeah.
But if your house, you just bought your house recently last year, so you don't have to compare with neighbor. You just use your house purchase, right?
No, you still do, because as Evan said, and oftentimes when somebody calls Evan and they want to appeal it, he'll call me and say, can you help me pull together some comps, because Shannon, you may know the houses. It doesn't matter, even if your neighbor's house is very similar, and even if you bought yours last year, we can only use comps of homes that sold in the previous year.
Right. So it's good to have your sale, but it's not determinative. It's not enough to only have your transaction. It's good evidence without doubt, but it's not. You need more evidence to say, hey, the price I paid was justified.
And can you typically track down comps?
Well, of course it depends on how realistic you are, right? So I'll often have, again, past clients, friends, whoever, call me up and say, Shannon, can you help me? I think I paid too much in taxes. And I'll say to them, well, what's your assessment? And they'll say, $1.5 million. And I'll say, all right, understood. If I were coming to your house to list your house tonight, what price would you want me to list it for? And they'll often say, I don't know, $1.8 million, $1.7 million. I mean, I'm not, it's funny,
Happens
but
all the
it
time.
happens to me
All the time.
during this January to April time period. I don't know, several times a month. So can we find good comps? Not if your house is actually worth $1.8 million. We're happy to try, but it just depends on how realistic you are.
And the question I get all the time is, hey, Evan, I pay a lot in taxes. Can I lower it? Well, your house is worth what you pay, and you're paying your fair share. And you know, I assume everyone here, we live in New Jersey. Taxes are high here. That's just part of it. And if, you know, it would be great if everyone lowered our taxes, but then the government would have to raise the rate to continue raising the money. So it really is, you know, it really is about paying a fair share, because everyone's going to pay too much. Just the nature of the beast.
But didn't you mention the comps that we find has to be of a value as of October?
Correct,
last
because
year?
the question in the tax appeal is, what was your house worth as of October 1? So the best evidence is closings that occurred between January 1 and October 1
Of that previous year.
of the previous year.
So you discount any sales that took place during the time you must have filed it.
Absolutely.
You can't use the January to April sales.
I don't want to say can't use. As a lawyer, you know, the words are always real strict. The best evidence is January to October 1. If you have a unique property and there are other comps that fall outside of that, they can have some value. But if you can find comps between that time period, I mean, for a good example is, if all the comps during that time period show value X, but you have 4 comps that close between January and March showing value Y, wait a year. It's just, that's the way it is, because the question is October 1 of the prior year, and ideal evidence is looking backwards.
Why don't they use October, November, and December sales?
So again, they can. You can. I mean, so I've done many tax appeals where I'll look for comps in the August to October time frame and maybe find 1 or 2, but then find another 2 in the month of October.
Right.
They're just not weighted evenly. They're all counted, but really the question is, what was it worth on October 1? So if you're looking at stuff after October 1, maybe prices rose, maybe interest rates dropped on October 5th, leading to an increase in purchase pricing. That doesn't count for the October 1 date. So a tax assessor will combat those, you know, if there are external factors.
But how do you decide this is a comparable houses? Because like you said, some houses just very old, some are just new, and just in my neighborhood, some are just new.
The answer is, you know it when you see it. You know, you know when you're walking in a property, hey, this is similar to my home. Oh, this one is not. And that's what you use expert realtors for. And when necessary, you hire an appraiser.
And we're going to argue that they're very similar streets or they're very different streets. If one is a little bit higher, you'll say yes, but that's Lake Drive, and maybe that's an A+ street, and maybe the street that you live on might be looked at as an A- street. So it's a lot of it's common sense and the ability to support. They're both 4 bedrooms. They both have 3 bathrooms. They're both split levels. They're both on 1/3 of an acre. They're both in similar neighborhoods.
And you know, one of the things, if anyone's looked at an appraisal report, the appraisal report will often say, have listed some comps, and they'll say comp 1 sold at $850, comp 2 at $950. But then underneath of those, they list pros and cons of the property. They might say, oh, nice level backyard, plus 10%. Oh, this one's on a double yellow line street, minus 10%. So you know, none of this is an exact science. There is no the formula where you're like, yep, that's a comp, that one's not. It's
Well, which is why don't you speak to the 15%?
right. So that's the next
Okay.
part. So this is so now that we got all of that and how that works and what you're looking for, there's one more wrinkle that makes tax appeals a little difficult, and that is that the government doesn't like to be wrong, and the government makes the laws. So there's this law that they are allowed to be wrong by up to 15%. So you don't simply show, in order to win a tax appeal, you don't simply show that you're overassessed. If you're overassessed by 3%, you don't win your tax appeal. You can file the board, the county board, county commissioners, so I'm going to just call them the court for this purpose. The court will look at that and say, you know what, homeowner, you're right. You're overassessed by 5%, sorry. And you lose. It's just that simple. So when we're looking back at the chapter 1-2-3 ratio, this upper limit represents the 15% window that they're allowed to be wrong. So the average ratio, again, is the ratio actually used to convert an assessment into a market value. The upper limit is the ratio you use to determine if you're actually going to win a tax appeal. So that's how those ratios work. And the 15% window is important, because if you're not outside of that window, if you're within that window, you lose. And it happens all the time. And that's why it's important also to have some strategy behind this.
Would you ever go would a real estate attorney ever take you to try and appeal your tax appeals if you were within that window?
Probably not. And not simply because they wouldn't, because I've had clients who've said to me, Evan, I understand your advice that I'm going to lose, and I want to file anyway. The reason why I don't usually is, number one, it's bad business. I don't want to take a client to a hearing and lose. So if I know I'm going to lose, I'm setting everyone up to be angry at me, and that's just not worth it. I'd rather tell them ahead of time, I don't think this is right for me. If you want to file it, please feel free.
But what you're saying is like there's not a chance.
Correct. Now the only opportunity would be, number one, if the tax assessor, by their good graces, agrees to settle with you. Or number two, you make such an incredible argument that you argue outside of the 15% window and get it. But if you're going to sit there and make the argument of that your value is within the window, even though it's different, the court can't grant you relief. They just can't.
Evan, how many comps should people usually expect to find?
I think that if you're really trying to present a good argument, the minimum is 3. More than 5 is overkill. That's kind of the numbers. If you have 1 comp, it's not really, you're not making a good case. 3 is kind of making a good case. 6, 8 starts to mean like you're stretching for something. So I generally think 3 to 5 of the best ones that present your case the best are strong. And now keep in mind, they don't all have to be showing the value you want. I've used comps that have values higher than we want. But we've said, this might appear to be a comp, but here's why it's a more valuable property. And you explain that. And when you explain that, it's still a comp, but you take off deductions for it. And it brings you back into the value. So it's simply listing a comp and saying, 123 Main Street sold at 500 and 456 Main Street sold at 500. It doesn't, I wish it worked that way. It just doesn't. You don't ever find those nice clean comps. So you find the comps that are best representative, and then what I do is I explain those comps. I usually send a letter to the tax assessor, with the comps saying, this property has updated kitchens, please feel free to view the listing at this website, all those type of things. And that's how you kind of account for the ups and downs in any comps.
So this one doesn't have the 50% relief here.
No, this is showing,
Sale price.
That's
Yeah.
just only sale price.
correct, that's showing you the sale prices. So you might go to that to look for your comps. So when you're looking at comps, there's also a lot of comps that are discounted entirely. Any distressed sale. And by law, certain sales, whether or not they're actually distressed, are distressed sales. So distressed sales are generally short sales, bank-owned properties, but they are also any estate sale. So if the seller is an estate, that evidence is discounted. If the sellers are going through a divorce, that evidence is discounted. And whether or not it was actually distressed as a sale, those are just simply ignored as evidence. So it's important to have a little background on your comps and not simply find, my neighbor's house sold so low, I'm going to appeal my taxes. Well, maybe the same owner lived there for 60 years and just passed away, and their estate, who's based in Texas, just took the first offer they could. That's what the tax assessor's going to say, and ignore that comp.
And how do you if I was to hire a real estate attorney, would a real estate attorney go do more due diligence on those comps to see in order to make the case that those comps are the comps there. I mean, like, I could look around at comps, but I can't make this case, oh, well, this one has a newly
Correct, yeah, I
renovated
mean-
bathroom. I don't necessarily know, I'm not.
Right. So, and look, as a real estate attorney, I am not an expert on valuation, and I'm not an expert on all of the different properties. So I rely on real estate agents to help give me that advice and to bring those comps. But part of my job is also, as a lawyer, what all lawyers do, is we create a narrative. And, you know, I know how to present the best case to the tax assessor, and through my experience, I know what tax assessors look for, and I know what not to present to them because they're going to dismiss it anyway. So it really is about presenting your best foot forward and knowing what you can present. Whereas if you just simply present a list of comps, the tax assessor is just going to be like, I can win this one. No. But if you show that you're doing that diligence, show that you can explain some of these comps, even when you don't have that first-hand knowledge, when you make that first impression where the tax assessor looks at it and says, yep, these people know what they're talking about, I don't want to go to a hearing, that's where the lawyer can add value, because it can be presenting that case in a way to give that a realistic chance of winning, and usually winning quickly. Now that being said though, if the assessor is really adamant about not settling and there really is a hearing that's required, that's when an appraiser is usually called in. And the reason an appraiser is called in is because the court, all courts, look at the appraisal license as being able to determine value. They're considered an expert witness in any tax appeal. So they can be brought in and they can actually testify and enter evidence about the value of properties. So much of what I was discussing in terms of presenting the case, that's a lot of it is done for the purpose of settlement. And because because I do my due diligence, make sure it's a valid tax appeal, I can go to a tax assessor and say, hey, look, this is a valid tax appeal. Here are some comps. Here's why we think it's comps. And usually get a settlement before we go to a hearing. Because if a tax assessor knows they're going to lose at the hearing, they're going to settle it anyway. So it really is about presenting a case to get it done efficiently. But occasionally you just need to end up with the appraiser anyway. So I'm going to run through.
You know what I want to talk about? So there's a couple of times when I recommend people don't do it, and one thing that's really important, especially in towns where the sale price is usually relatively close to the tax assessed value, so that's in towns where it's been assessed recently, usually. So again, we're here in Short Hills tonight in Milburn, and I just pointed out to you guys that things are selling at somewhere between 105 and 107%. So if you said, hey Shannon, I think I want to list my home this year, should I appeal my taxes? Unless they're way out of line, I'm actually going to say no. Because when you put your house on the market and somebody's now going to negotiate a contract with you, if your tax assessment is a lot lower, they're going to say to you, well, hey, things are usually only selling at 105%. Like, why am I going to pay you what you want? So you're kind of telling the world, I think my house is worth less than it is, and that can work against you in a sale. So I would say if you're thinking of selling in the next 24 months, I would be careful about doing it unless you think it's really far out of whack. What do I mean by that? I'd say maybe, in this case, I'd say more like 20%.
Right. It is a pretty much case by case, because you don't want to be on record arguing a value that you're going to end up asking for more. You don't want to present this beautiful case about why your house is only worth $800,000 and then list it for $1 million, because there's just a certain dynamic there where no buyer is going to say, wait a second, you just lowered your taxes. You were just able to prove
that your house was
inexpensive your house was. Why are you asking so much?
As a real estate agent around here, would you be sensitive and would you pick up on that kind of dynamic?
Absolutely.
If I was hiring you to be my real estate
Absolutely. That's a conversation I have multiple times a week. When I sit down with somebody to talk about listing their home, that's one of the first things we talk about. First of all, most homeowners ask me, should I appeal my taxes? Because of course everyone thinks they're paying too much, right? Then when I say, well, here's what I think your house is worth, what do you think your house is worth? And they see the discrepancy and they understand this ratio. And they understand that buyers around here are very savvy and the buyers are gonna know the ratio. Then they usually opt not to do that. However, it is worth a conversation if you think you're starting to hit that outer limit where it might make sense, because let's say you're gonna list your house for $1 million, and and your house compared to all the other houses that are listed for $1 million have much higher taxes, then sure, that's gonna work against you, because why does anybody wanna buy your house if your taxes are so high? So it's a thin margin, and it's really why you need a team. You need a real estate agent whose opinion you trust, and many times we would get a real estate attorney involved as well. There's a subtle difference. The other thing that can happen is sometimes we price a house and a seller will say, look, Shannon, I really want to list my house for $1.3 million. Okay, if I think that's at all reasonable and we list it for 1.3, their taxes might be in line with a 1.3 house. If the market doesn't respond to that price and we need to do a price reduction, then oftentimes you do cross that line where you're more like 15 or 20% too high. So oftentimes this time of year you'll see homes that are listed on the market and there'll be something in the fine print that says, home is currently appealing the taxes. So it's a fine balance. You gotta stay on the edge and make sure you're not too far off.
It also is, I've also been in situations where they've had tax appeal pendings and actually rejected offers because the offer was higher than what they were arguing in the tax appeal. Now it seems totally backwards, but they've usually said, okay, we have to reject your offer right now because we don't want to go under contract. But if you wait 3 months, you're going to have really lower taxes. But that also scares the buyer away. Because they're saying, wait a second, you're arguing lower than this and you're going to win. Why would I pay that price? So, even if you're going to file that tax appeal, simply having the tax appeal pending can be a blessing and a curse. If you get someone who's confident in their price and willing to pay lower taxes, it's great. But a lot of people are very analytical when they look at these and they look at those numbers and just aren't willing to move forward. So I was going to run through, out on the tables, everyone has, or there should be a little stack of worksheets that look like these. These are the worksheets that I kind of have put together so that people can get a rough idea whether or not their property would be valid to do a tax appeal. And I have 2 different ones here that I'm just going to show you how we work them so that anyone can do it.
For this table?
Oh, there should be some
This
pictures
one.
around.
Right over here.
Cute.
So I literally picked 2 properties, 2 local properties to just kind of run through some numbers and show you how this works. So the first one was 24 Jefferson Avenue, which both of these properties closed within the last year, so that's how I got their market values. That property, it's right here in Short Hills. It recently sold for $1,735,000.
Wait, so what are we looking at these?
Those are for you guys. I'm showing you how the form kind of works. Feel free to go through. So the sale price, market value, 1,735.
Yep.
The assessed value on this property was $2,327,100. So it sold $2,327,100. So it sold significantly under the assessed value. The next 2 boxes are from the Chapter 123 ratio. The average ratio here in Millburn, 92.31, and the upper limit is 106.16. So the average ratio was 92.31, and the upper was 106.16.
106.
Yep, 0.16.
That's plus the 15%.
That's the plus 15.
Right.
So that 106 is 92.31 plus 15%. So that's the information on the top. That's kind of just the collection of information that you can start analyzing from there. The next 2 boxes are where you do your analysis. The first one gets us to what the property's ratio is. We talked about the average ratio is across the town. Now you want to know what is your property's ratio. And to determine that, you do the assessed value divided by the market value. That comes up with a number. Based on these numbers, we come up with 134. So when you're looking at that math, at 134, obviously 134 higher than 106. This is a valid tax appeal. So we look at these numbers and this is a sure thing. But I always like to double check myself. Any work I did. So the second calculation is what did the town actually think this property was worth? So we go back to the assessed value and now we divide it by the average ratio. That gives us a value of $2,520,000.
What was the assessed value again? 2.37?
23271.
23271?
Yep. The town previously thought this property was worth $2,520,000, and it sold for $1,735,000. That's a good tax appeal. So I've double checked. This is absolutely a good tax appeal. Mostly makes sense to everyone? So that's looking at a successful tax appeal.
Yeah, the other examples.
Next one is not as lucky. This property is in Livingston. It sold for $769,000 with an assessed value of $717,800. In Livingston, the average ratio is 84.96 and the upper limit is 97.70. So when we do our math here, assessed value divided by market value, it comes up with a ratio of 93.34. This is a tough property because it is above the average ratio, meaning that they're overassessed. But it is less than the upper limit. So this is an example of that property that is actually overassessed, but isn't going to win a good tax appeal this year. So when you get this, this might be a situation, if this client calls me, I would say to them, don't file a tax appeal. Because both of these properties closed within the last year. Don't file a tax appeal, you just closed. The town is going to look at your closing and say, you paid this price, that's what the property's worth. Rather, and this literally happened to me last year that we're filing a tax appeal this year, I would tell my client, let's wait, put the tax appeal off. You're gonna pay your too high in taxes, but hopefully you knew what your taxes were before you bought the property. Pay your taxes, let's file a tax appeal next year when your old comp is no longer a good comp. Now we can go ahead and create a better narrative of what your property is worth using comps from the last year. Now it's always possible that prices go up, but if prices go up, that means your house is worth more. Not the worst thing in the world. You won't be able to lower your taxes, but you couldn't do it anyway. So you're right back where you started. Yes?
Yeah, but if a person wants to sell their house, and you're telling them to put off the appeal till the next year,
Look,
they're
well-
theoretically going to have sold their.
Oh, no, absolutely. And my advice doesn't apply to everyone who calls. It depends on their specific situation. If they say, you know, Evan, my taxes are crazy high, I can't sell my house because the taxes are too high, and I'm trying to sell so I can move to California, that's going to be different advice than someone who just bought their house and says, you know what, I can live within my taxes for a year and then try and create a better tax situation.
What about if you're looking to sell and your taxes you know are low because you filed an appeal last time, the taxes, in the case this is some.
Yeah,
so
I mean-
this is years ago that it was filed.
Right. I mean, at that point, they are what they are. You know, unless if your taxes are low, market that as an attractive aspect of your property. You know, in theory, everyone wants lower taxes. So if you didn't file a tax appeal within the last year or so, right, then you don't run into that situation of going against what you argued. If this was years ago, great, you just have low taxes, and that's going to be a selling point. So yeah, I mean, I'm kind of giving the general advice, but you know, when you learn someone's personal circumstances, the advice always gets tailored to those situations.
So the key is the market value. Right?
Yeah, I mean, having a good idea of your market value is vital. You know, it's very important. And, you know, knowing what activity is going on in your neighborhood, in your town, keeping your ear to the ground, you'll know your market value. You know, speaking with real estate agents, that is how you can tell. And when you're, you know, look, when your market value starts shooting up, that's some good news. When your market value drops, tax appeals are a good way to get some relief.
So right now actually it's getting lower. The market is not so hot.
The market's not so hot, but prices aren't really, I mean, you know, every micro market is a little different. You know, I know, for example, the Short Hills market of, you know, $3 million is a little slow, but $800,000 sells in a second. So every little micro market is a little bit different, and knowing where you fall within your market is vital. You know, you should always, for a whole host of reasons, you should always have an idea of what your property value is. And look, value is important. important so that you're properly insured, because if God forbid something were to happen, you want to be insured for the right amount, not for the amount that your house was worth 10 years ago. So keeping all of that up to date and having kind of a feel for what your property is worth, you're not going to know to the penny until you put it on the market. But having a feel for it is important and helps you do this analysis.
What's the best way to get an accurate feel for it on a day-to-day, month-to-month basis?
Keeping track of what's going on, speaking with real estate agents, getting an idea, hey, how's the market looking in my town? I live in this neighborhood of my town. How's that selling? Is it hot? Is it cold? I'm right near train tracks. How bad does that affect my value? So that's where a real estate agent can really come in and tell you, hey, you bought your property 3 years ago. Prices have gone up a little bit since then, but your neighborhood is actually up 10%. That's good to know.
Do you want to talk a little bit about the best way if people want to hire you to do it
So-
how you work?
Yeah, so one thing that I always like to advertise a little bit is that, and you'll all figure out why in a moment, is that my success rate with tax appeals is almost 100%. Because I vet all my cases ahead of time. I don't take things on unless they're going to win. So when I get a phone call in, if someone's interested in a tax appeal, I take all their information down, and I have a similar worksheet. Mine's the one that I use internally has a little bit more on it, but I fill it all out myself. I do all my math, and I determine whether or not this is a good tax appeal. How close is it? Then I like to go through these numbers with my client, explain where they fall out, outside the window, inside the window, what it's going to take to win a tax appeal. I charge a contingency fee, as most property tax appeals do. If we win, I get paid. If I don't get paid. Which is also why I don't take on ones that I don't think I'm going to win, because I'm not interested in working for free. So those, when I get those phone calls in, we analyze it. If it's a good tax appeal, we have a retainer, we sign that up, file the tax appeal. It is then a slow process. It does not happen really quick.
How long is the
Most
process?
most tax assessors won't really start negotiating or kind of settling any of these until around May. And the reason for that is they want all the tax appeals to be filed. So that's January to April. They want to see what they're going to be up against for the year, and then they start analyzing on their own end. So that usually happens around May. We start getting hearing dates, usually end of May through the summer. If I'm able to settle it, we sign a consent judgment, that gets filed. If not, we go to a hearing, we get a judgment, that gets filed. From once the judgment gets filed, now you're kind of in limbo. Because, and I'm sure all of you know, your beginning of the year taxes are different than your second half of the year taxes, and that's because the budgets get finalized in the middle of the year. Until those budgets are finalized, your new assessment won't kick in anyway.
Oh,
So-
so we still have to pay tax.
You still have to pay. However, if you win, it's retroactive to January 1.
Okay, that's.
So, if, for example, and I'll just make up numbers for a second, if your taxes were $20,000 and we've reduced them, if your taxes were $20,000, you're going to generally pay $5,000 a quarter. If you then reduce it down to 15, you're going to end up having paid 10 for the first half, and then you're only going to be charged $2,500 for the next 2 quarters. But then you're going to end up paying a quarter of 15 for the next year. So it goes down before it goes back up. The other reason why it also takes a long time for everyone to get the benefit of it is because most people pay their taxes through their mortgage company. So when you get your new tax in August, let's say, now it has to go over to your mortgage company. And then they recalculate your escrows. Now your escrows are too much. You finally get a refund from your mortgage company. And then months later, then they adjust your payment. And now it's November, and you're finally like, yay, we won. So it doesn't happen quickly, but it is retroactive to January 1. So you get the net benefit, even though you do have to carry those higher taxes in the meantime. And then everything's happy, and you have lower taxes, and hopefully that works out for you.
I know for those of you that have the paperwork on the table, of course my contact info is there and Evan's is there, and for anybody that's watching it on Facebook Live, you can just message us and we can put you in contact with Evan. Obviously you're a wealth of information on these. It sounds like you actually kind of enjoy doing them.
Yes. It's fun to create that narrative to kind of argue something in favor of a client, so it's nice.
I really appreciate you coming. It's,
Thank you for having me.
such great information that's so relevant to so many people. So thank you.
Thank you.
Thank you.
You got everybody. Feel free to stick around.
I'm here to answer any
Have some
questions.
cookies, coffee, and questions.